Welcome back to the Dividend Diplomats YouTube channel, guys. You've got Bert and Lanny, the DD, your favorite dividend investing channel, right here, right now. We're going to dive into three stocks that kind of are back on my radar. One I have been buying because I've been trying to get to 100 shares. Check out those other videos if you haven't already. The other one I've owned actually almost since my dividend investing journey started back in 2009, 2010, but they're on my watch list because it's like, why the F not, guys? And the other one is probably an out of flavor stock that cut their dividend, but has rebounded their dividend. And it's the metrics are the metrics, and it's hard to not look at what they look like right now.
You know why I'm laughing, Lanny? One of these stocks almost made the cut for my watch list that we just put out on Sunday. I was this close to adding it in there. I kept it off to keep it at 2. So it looks like it made it on to yours. Let's freaking go, everybody. If you have not already, before we talk about these three companies, subscribe to this channel. Give this video a thumbs up. Everybody, let's reach financial freedom together. Lanny, let's freaking tell everybody the stock you are watching here for the rest of June. Let's go.
Let's dive into CVS, ticker symbol CVS. We'll look at WestRock, ticker symbol WRK, the big paper, cardboard, pizza box manufacturer and distributor. And we're going to dive into and then another stock that maybe people don't really like as much anymore. Pfizer, ticker symbol PFE. And Bert, we're going to run into the DD stock screener metrics. Obviously, the price to earnings ratio less than the S&P 500, which is trading at almost 26x. Dividend payout ratio less than 60%. History of growing dividends. Then we'll look at the dividend yield. Similarly, we're throwing the 5-year average yield as we've been doing recently, just to show you where they currently are at versus where they've been at. Bert, what are we thinking here, man?
We're thinking that investing in 2023 is chaos right now. It is pure chaos. I don't know what really more to say. S&P 500 is up, but it sure as heck does not feel like that. It doesn't feel like the economy is booming the way the S&P 500 is telling you. Sure, tech is rallying, but you're seeing retail start to show those signs of a potential recession coming, of decreasing consumer spend. It's just a weird year, but the important thing is, no matter what the market is telling us, we are always looking for the stocks that meet our metrics. We stick to the same metrics so we can tell what companies are in and out of the buy zone for us right now, so that when times are great and times are bad, we know what stocks are undervalued no matter what.
Yeah, I mean, the stock market has been more volatile than ever, guys. It's almost like these windows are shorter and shorter when there are opportunities to buy. So you always have to be ready when there are opportunities. Again, the S&P 500 is up well over 15% this year in 2023. It looks like they're not going to have back-to-back down years, which has been rare. Obviously, 2022 was that down year. So let's get into CVS, guys. And then another stock that people hate because of the debt, because of the history that's unusual for dividend growth. Guys, that's because CVS is acquiring and trying to grow and capture the entire healthcare as much as they can. So CVS is trading at 67.72, and they're actually getting crushed this year, down 27%. Forward EPS right now by analysts is still $8.60. So that's a PE ratio below 8.
Love it. 8, everybody. It's more than a third of the, what was it? Less than a third of the S&P 500. That's what I meant to say. 8, everybody. Lanny didn't misspeak. 8 PE ratio. Their annual dividend is $2.42. They have a very low payout ratio of 28%. That is freaking low, and it's probably by design, because if they're acquiring companies and they're working to pay down their debt, you can't pay out a ton of your earnings, so you have to keep the payout ratio lower in the short term to fuel the other key components of maintaining their balance sheet.
Now, again, we're going to get into dividend growth. They've only been increasing it back since the Aetna acquisition for 2 years running. So even with a bunch of years at zero growth, and they never cut it, but with zero growth, they still have a 5-year average of 3%. So that just speaks to when they do grow it by a pretty large amount. And then the dividend yield, because they're down almost 30% this year, 3.57%, which is about 60 basis points higher than their 5-year average, which is 2.97%.
You see me shaking my head because it's insane that CVS's yield is back over 3.5%. I mean, let me run through the metrics, but it's pretty clear why this company has risen to number 1 on your watch list for the rest of June. 7.87 PE ratio, payout ratio of 28%, 3% 5-year dividend growth rate, 2 years of increase in the dividend since they started after the Aetna acquisition, with a yield of 3.57%, despite the fact that they are down 27% year to date.
And I'm over, I think, 91, 92 shares now in
Oh
CVS. So
man.
I
Oh
am game.
man. Gotta get it to 100, baby. You have to do it, do it, do it, do it. All right, everybody. Yeah, let's go. Let's go. Frank. All right. Yeah. Get it to 100. Let's go, everybody. Let's talk about number two here. I bet you didn't think we were going to be talking about WestRock, ticker symbol WRK. I don't know if you guys know this or not. WestRock, if you buy your diapers at Target, flip the box upside down. You know who sells those Target diaper boxes? WestRock. And let me tell you something, Jack. Those are some sturdy boxes. They make some quality boxes because we've repurposed them for plenty of other stuff too. So, Lanny, let's talk WestRock. Why are they on your watch list?
As WestRock, they're kind of in an industry where things are still shipped in cardboard. Paper is still being used. Shipping. I mean, I have a whole room full because, Bert does it as well. But I side hustle a lot on eBay and Mercari. We've obviously recycled a bunch of cardboard, but I've got about 50 cardboard boxes from previous shipments. I'm trying to reuse,
Yeah,
not produce new ones. But
very eco-friendly.
yeah, got a lot of cardboard, and I eat a lot of pizza. Everybody knows I eat a ton of pizza once a week, every Friday night if I can. I'm picking up a pizza or I'm making a pizza, and WestRock is in the pizza box business.
So here's the question everybody wants to know. Are those the boxes you're reusing to send out the stuff you sell on eBay and Mercari? Are you sending people greasy
Yeah,
pizza
I
boxes?
just spray a little Febreze on there. But guys, so yeah, WestRock again, they're also down 29% in 52 weeks. Obviously, they have some debt on their balance sheet. And during the pandemic, they also they called it the right sizing of the dividend. They reduced that dividend downwards to just pay debt, kind of manage their balance sheet a little bit better. But since that cut, they've actually increased it quite a bit. So it's always nice to see that. Okay, let's get back to business here. So you'll see a negative dividend growth rate here when we show it because of the steep cut, and obviously there's been a few increases since then. But Bert, they're trading at 29.48. What do the metrics look like right now for WRK West Rock?
Let's go. 40 EPS, 252. That's a PE ratio of 11.70. So again, well below the 26x for the S&P 500. Lanny, you want me to keep rapid firing some of these or?
Hit him hard. Hit him with the
left.
hit him with the right, Rocky style.
All right, their dividend is 110. That gives you a payout ratio of 43%. So again, another stock over the last few weeks that is right in that perfect payout ratio range. And they've increased that dividend for 2 years despite that dividend cut. So after the right sizing, they're on the road back, and they had a pretty nice dividend growth streak going before the pandemic. And the yield, let's end it with a very solid yield, 3.73%. So beautiful.
And to give the guys a fair mind, there was 46.5 cents per share per quarter before the pandemic. They cut it all the way down to 20. They brought it back to 24 within a year. Then they brought it again all the way up to 25 cents. Now they're at 27.5 cents. So they're still, quite a bit away, 19 cents away from where they were pre-pandemic. But the increases have been substantial, the last one being 10%. So going from 20 to 27.5 cents in 3 years is actually very significant. So, they've shown that they want to keep doing it. So the next dividend announcement could be a dividend increase as well. So just keep your eyes peeled on that. That could come. It's either going to come in July or October, I have a feeling.
All right, well, let's do it. I love it. WestRock here. Love that dividend stock number 2, Lanny. So everybody, that first stock was CVS. Second stock was WestRock. Shall we move into number 3 here, Lanny? Shall we do it, Chico?
Guys, Pfizer, ticker symbol of PFSSA. Yo, where's my chains? Price is $40.06. Again, everybody's fear right now is that they have no products left after the COVID vaccine. Pfizer was here before the COVID vaccine. Just a heads up there. I know it's a significant part of earnings and revenue, but again, they're not in business just because of COVID.
An important
forward earnings per share right now is $3.35. They have a P ratio less than 12. And you know what I like is that their dividend payout ratio is less than 50% at 48.96%. So in that sweet spot, just like WestRock, not quite as low as CVS. But they've been growing dividends since the year I owned them. They resumed dividend increases post the financial crisis. So they've been doing it for over 12 years, even after they even increased it after the Viatris spinoff.
I love it. They had that secret dividend increase because they didn't actually cut the dividend post Viatris, which was freaking beautiful. I don't think you hit them all except the yield, Lanny. So what is Pfizer's dividend yield?
It's not 2%. It's not 3%. It's not 3.5%. It is over 4% now for Pfizer, which is above the 5-year average yield of 3.88%. So about 21 basis points higher than that. But it is over 4%, again, over 2x the S&P 500, similar to the other stocks on this watch list. And I've been kind of having a rule of thumb lately. I love BYM. So to buy sometimes an individual stock outside of like one of the top 5 foundation stocks, I'm usually looking at a yield that has to be above VYM in order for me to chew on it.
I like it. I dig it. It's a fun rule. So it's obviously see why Pfizer hits that. So I think all three on this list hit it. CVS is going to be pretty close with the 3.57% yield. It's still close enough where depends on the quarter, depending on the VYM increase, but not VYM, CVS clearly covers it. WestRock's at 3.73%. That's a check mark right there. Pfizer, obviously at 4%. That's a check mark too for that nice little rule of thumb.
Yeah. And again, we're not chasing yield here again, but it just, if I'm taking on additional risk than an ETF, you kind of want a little bit more on that. But the metrics speak for themselves, all with PE ratios below 12, all with all with payout ratios below 60%. Again, dividend growth is probably going to be strong with WestRock is my inkling as they keep resuming it. Probably no growth this year, possibly with CVS. We'll have to keep your eyes on Q4. And Pfizer may do just, their typical maybe 1 cent increase. But we'll see. Again, I can't predict that, but that's kind of what the trend has been for good old PFE.
So everyone, let us know what you think of CVS, WestRock, and Pfizer. Those are the three companies here on Lanny's Dividend Stock Watch List. If you haven't already, everybody, make sure you subscribe to this channel. Give this video a thumbs up. And Lanny, I'm so confused right now. What is it that we need to tell the people here?
You're either with us or you're against us. NWO Hogan style. That was Bert and Lanny from the Dividend Diplomats. Over and out.